Hello everyone, welcome back to my channel CMA Future. So please guys share my video shorts to many of your friends so that they can learn easily. So in the last class we studied about accounting, fundamentals of accounting basics, bookkeeping, financial accounting, cost accounting, management accounting definitions we saw, and we saw the users of accounting informations. Today we will see objectives of accounting. In objectives of accounting, systematically recording all the transactions, determining results of recorded transactions, determining financial position of the company, providing the users with the required information, understanding solvency position of the company. So this all I have just drawn to remember, understand it. You can write it like this also in the paper, or better you write it like this. So I have made some important questions here. So the procedure I have written like this thing just to remember and make my own easy work. I just prepared like this diagram, but in the exam you write it like this. Okay, so I have written how I have written here accounting meaning in just 2 lines, and then procedures, and the users have just written like this. Okay, here only the accounting up part I have written the meaning, so I just did not write it again here. If you want, you can write it here also again. So this type I have written. So objectives like this you write when they ask it in the question paper, to make your own words or to remember like this I have written. Okay, just in chart after. So same things I have written, just slightly change. Systematically recording all the transactions through journal entries, ledger and trial balance, determining the results of recorded transactions by preparation of profit and loss account, determining financial position of the company by preparation of balance sheet, providing the users with the required information through annual reports and statutory fittings, understanding solvency position of the company. Okay, so the next topic comes accounting cycle. In accounting cycle we record the accounting information, what all things we record, the transactions we record, then next we do journal, then we classify it in ledger, this is classifying, then we summarize the ledgers in trial balance, then adjustment entries we do. If we need to do any adjustment entries, we have to pass and then we have to prepare the adjustment trial balance. After adjustment entries, we have to prepare the adjusted trial balance, and then closing entries will prepare, then the financial statements. Okay, in the last class I have told what all the financial statements: trial balance, profit and loss account, balance sheet, cash flow statements. Okay, now next, accounting terms. What all accounting terms, some terms are there which we have to know. So first one is transaction. In business entity there is a in every business entity money or money's worth is measured in terms of money. Transactions have been transactions we have prepared. For example, purchase in cash or credit. So the purchase is transaction, whether it is in cash, check or credit. That is, credit means after 10 days or after 5 days or after 2 days also the payment is made. That is called credit. So this is transaction. Goods, tangible articles, business in which business deals. A is an organization which deals in a furniture, so for that it is goods. B is an organization, does not deals in the furniture, B organization does not deal in furniture, but A organization deals in furniture. So for the A organization, furniture is a goods, but for B organization, if B organization purchases from A, then it does not called goods, because it will be purchases for them. So what is goods? Then services. Services are intangible, goods are tangible. So services are for from normal business. It whether they are in monetary, that is more in terms of monetary or non-monetary, both are this, both are recorded. So next comes profit. Revenue minus expenses is profit. Profit can be found out for a transaction or for the whole organization. Loss. Loss is expenses minus revenue is loss. Even for losses for the transaction we can find out, or for the whole organization we can find out. Next comes assets. Assets are resources owned by the business. For what reason? For to generate the future profit. Assets are tangible assets, intangible assets. So what is tangible asset? Tangible asset is where you can touch it, you can feel it. So that is called fixed assets, inventory, stock. Inventory means stock, building, furniture, anything which we can feel it, that is called tangible. Intangible, where we cannot feel it, we cannot touch it, like services. So assets are current assets, non-current assets. So current assets, there is an 4 conditions which you have to fulfill any one condition of that. In these 4 conditions you have to fulfill any one condition, then it is current assets. Expected to be realized in the company's normal operating cycle. Okay, in an operating cycle, normal operating cycle of the company, in that period the asset should be realized, then it is current asset. Primarily held for being traded, means for the trade, business trade, it should be held. Realized within 12 months after reporting date. Okay. Cash or cash equivalent. Liability for more than 12 months to recover. If cash or cash equivalent is used, then it is not covered on the current assets. This cash and cash equivalent liability more than 12 months, if it is if it takes time, it is cash and cash equivalents are used, then it is not covered under the current assets. So these 4 conditions, in that any one, if it is used for more than 12 months, means realized for more than 12 months, if it is within the operating cycle of the company, and it is being held for the trading purpose, then it is called as current assets. So which are current assets, what are non-current assets? Which are not current assets, those are included in the non-current assets. So next comes liabilities. Liabilities is nothing but obligations of financial nature. What the business owes, that is amount of money business owes to the other parties, that is called current liabilities. In liabilities also current liabilities is there, non-current liabilities is there. So current liabilities, same 4 conditions are applied, any one of the conditions is to be satisfied, same like before. Next comes internal liabilities, where owner's equity, capital, reserves, undistributed profits, owner's equities represent internal liabilities. Next comes working capital. Working capital is nothing but gross working capital, total current assets. What all is included in gross working capital? Gross working capital, long-term internal liabilities plus long-term debts plus current liabilities minus amount blocked in fixed assets. So these are all included. Net working capital means what? Current assets minus current liabilities. Okay, we have seen what is current assets, what is current liabilities. Next comes contingent liability. Obligations created depending on the outcome of an event is called contingent liability. Next comes capital. What is capital? Capital is when we start a business, the owners give some amount, that is called capital. Business started by the owners amount is called capital. For owners it is the liabilities, so it comes in the liabilities of the balance sheet. Drawings, where partners or owners of the company use for their own business from the use for their own purpose, not for the business. From the business they take the money and they use it for the personal use, then it is called drawings. That is cash outflow it goes. What is net worth? Net worth is total assets minus total liabilities. What is total assets? Current assets plus non-current assets, total assets. Current liabilities plus non-current liabilities is total liabilities. So we minus, we get the net worth. Non-current investments. So investments made for not more than 12 months, not for the operating cycle, not for trading, it is for long term period. Current investments means what? For long term. When investments are made not more than 12 months, where it is not in the normal operating cycle, it is not provided for the trading, it is called non-current investments. So what is current investments? Where whatever the conditions are applied for current assets, those same conditions are applied for the current investments. Next comes debtors. What are debtors? Debtors are nothing but the sales where we make sales for credit purpose. Those customers are called as debtors. Debtors may be good debts, bad debts, or doubtful debts. Okay, 3 types of debtors there are. Good debts means where we know the amount will be received. Doubtful means sometimes the partly may be received or some amount may be received. Bad debts means where we know that this amount is not going to be received from the person. Next comes creditors. Next comes creditors. Creditors nothing but purchases where we make on the credit, it is called creditors. Next comes capital expenditure. Capital expenditure is nothing but on fixed assets we make directly related to the balance sheet, it is. Revenue expenditure where we earn a revenue for the period, utilize it. So revenue expenditure where we show in profit and loss account or the income statement we prepare, where there we show the expenses and the incomes. Next come balance sheet. Balance sheet is prepared for a particular period or a date, like end of 31st December we prepare, or 31st March we prepare. That is a financial year. If the company financial year is from January to December, we prepare on 31st December the balance sheet. For what reason we prepare it? For the financial position of the company to know, okay, at the end of the year. So assets, liabilities, capital, everything is covered under this balance sheet. What business owes, or what business owes means, owns means that is assets, owes means liabilities. So this is liabilities and assets we prepare. Next comes profit and loss account, where revenue and expenses are been recorded. For what reason it is recorded? To show the profit earned or loss incurred. In the accounting period, as I said, if the accounting period is from January to December at the end we prepare the profit and loss account. Next comes trade discount. Trade discount given by the wholesalers to the retailer computed on invoice price. So on which price it is computed? On the invoice price. By whom it is given? By the wholesaler. So when we purchase, when the retailer purchases something, some goods, then the wholesaler gives a discount, that is called trade discount, on that bill, on that invoice price. The trade discount has been given. Same cash discount. Cash discount means when cash is paid direct, now something we have purchased from a wholesaler, and then we pay it on cash there itself, so we get a cash discount. So directly we have paid. Next comes, so these are just name of the books and sources of documents. Which book, which document it is named as. Cash book, it is called as cash memos, cash receipts, and invoice voucher. Purchase books, inward or invoice. Sales books, outward invoice. So purchase will be inwards, we have purchased the goods. Sales, we have sold out, so out, it goes out, outward. Return inward, return inward. Credit note issued, debit note received, that is from debitors. Credit note, what will come? Issued will come, whatever we issue the goods, it will come credit note. Whatever we received, debit note. Return outwards, the sales return. Debit note issued, credit note received from creditors. Okay, in the next class we will see about bookkeeping and accountancy, difference between management accounting and financial accounting, difference between, and accounting concepts we'll see. Okay, thank you guys. Please share my video to many of your friends. Okay, and press the bell icon and subscribe my channel. Thank you. Bye bye.